Good morning, good afternoon, and good evening. Welcome to Crew UK's second Market to Market program. There are not many moderators who can say good morning across 4 time zones. So as you can imagine, this is a very exciting opportunity and moment for Crew. It's our first Market to Market. Let's see, that included Toronto and London, so Crew UK. And this time we're heading east and including London, India, and Singapore. My name is Michelle Cooper, and as a program consultant for Crew UK based in London, currently in the US, I'd like to thank you for joining today's presentation, which was developed as a means to connect real estate professionals globally, to highlight market conditions and share data about different asset classes within different parts of the world. And we believe there's no better time to bring people together for a sharing of intel, as the global dynamics are presently so fluid and not one-dimensional. Before introducing our panelists, and for those who are joining a Crew event for the first time, Crew stands for Commercial Real Estate Women, which is a global organization supporting members with business-to-business networking. As we just saw, Simon was introduced to a colleague of Penny. The organization also inspires leadership development, it creates career outreach, and it produces industry research. So Crew is in over 75 markets with 12,000 members globally. 75% of our members are in senior leadership roles, and more than 70 provide member referrals. So Crew Network quickly developed a plethora of virtual programming this year in response to the effects of the pandemic and changes in our workplace. And it will also host its annual convention via a virtual format in September from the 15th to the 17th. Wendy Mann is our CEO. She is leading the path forward. I believe she's joined today from Washington, DC. And I poured my cup of tea, Wendy. I never thought that you as my boss would be having tea at 4:30 in the morning, but we're both on the East Coast, and here we are, we're global, and it's amazing. For our attendees, you've been muted. However, we would very much like for you to place questions in the chat box during the presentation, and we will address them during the Q&A, which is after Simon's presentation. There is a great deal of information that has been pulled together, and a fair share of it is numbers-based. So if you're like me and you take notes, I hope you find this next bit helpful. We did the same for the Toronto-London Market to Market. We produced a brief summarizing the information being presented today, and then we'll post that to Crew UK's website by most likely Thursday evening. So without further ado, I am really pleased to welcome our panelists. Helena Hughes is a director with the Instant Group and a Crew UK board member based in London. Penny Mann joins us from India, representing many marketplaces in the country. And Simon Marion is a regional director also with the Instant Group, and he's based in Singapore. On behalf of Crew UK, for the 3 panelists, and for Pallavi, thank you for your time and your commitment to this event. Helena, this is your second Market to Market. It has been almost 3 months since the Toronto Intel Exchange. And as we were planning for this event with Penny, Pallavi, and Simon, it became apparent that things have seriously shifted. Would you like to highlight London?
Absolutely, indeed. I mean, 3 months, who'd have thought? It feels like an absolute lifetime, really, doesn't it? Since we were all allowed to do all the things that we used to do. But we're kind of 3 months on, and as I was looking at my notes, I could certainly see that things had moved in that period of time. So, you know, as we know, COVID-19 was a crisis that very few of us worldwide were prepared for. Its direct impact and the consequences of the efforts to mitigate the spread of coronavirus have put global collaboration really to the test. And it certainly makes today's forum far more interesting to have everybody on board, and the virtual networking that we've been doing has really changed things up, which I think is delightful. So I'm going to talk to you about the London market. If we think back to earlier this year, pre-COVID, the UK real estate sector was really enjoying quite a cautious recovery. Transactional activity had dipped in the lead up to our general election in December 2019, but primarily driven by uncertainty over that word that was very well used before, of Brexit, but has soon become a thing of the distant past, but no doubt will come back soon. As COVID-19 began spreading, it really paralysed large portions of our economy, and things changed. And now, only 5 months later, the UK is facing a recession, as I'm sure many countries of the world are about to experience or are experiencing. Real estate is certainly particularly at risk. We feel the pain and impact from every sector that are using occupiable space, some more than others. Many of you will have seen deserted London streets on the news and those wonderful pictures of our beautiful city. Speaking from my first visit to London last week for the first time in 5 months, usually I'd be in London 3 times a week. It was certainly very quiet and remains very quiet. Having said that, in the UK, it's not bad news for every sector. I'm going to look at each sector individually and quite briefly. But firstly, residential. So throughout the COVID-19 pandemic, everything, living sectors maintained their reputation for resilience and stable operating cash flows, despite really 2 months of relative inactivity, no house viewings, etc. The performance of the different living sectors is going to vary significantly. Everyone knows that our prime central London property market, has some high prices attached to it, and it's experienced significant spikes and troughs in demand over the last 5 years. Just as that market uncertainty around Brexit was starting to dissipate, COVID-19 came along, lockdown, and really everything stalled. So how is that London estate going to be affected in the long term? I think the answer is more hopeful than many might assume. The contributing factors that position 2020 as a year for recovery haven't just disappeared due to COVID. According to CBRE's latest residential report on Q2, the housing market is already showing signs of bouncing back, a pickup in approval, sales, and importantly, price growth. So despite that sort of weak economic backdrop, the housing market has rebounded. We've seen weekly transactions in England back to pre-COVID levels, according to the Energy Performance Certificate data that comes through on a weekly basis. And on top of that, CBRE data actually suggests a 1.7 increase in UK house prices in July, reversing a fall that happened in June. So we're expecting that to continue. In the UK government is subsidising a stamp duty holiday, and that's clearly a contributing factor. Interesting, there's also evidence, and I think this plays into our other sectors, that lockdown has really made households reevaluate where they're living. And according to a nationwide building society survey, 15% of people surveyed said they were considering moving as a result of life in lockdown. I'm not sure what that says about our family relations, but we shall see. I'm going to move on to retail. Unfortunately, this is one of our more challenged sectors. Retail have faced, an enormous challenge with COVID. They've had to work tirelessly to feed the nation, keep staff engaged and employed, and for many businesses remain solvent. Just this week, Marks and Spencer's, a very well-known British brand, of course, has announced 7,000 redundancies in the next 3 months. So that's a significant shift. Leasing activity was very slow in Q2, and central London continues to suffer more acutely due to a real lack of office workers and tourist demand. It's very, very quiet. Retailers are clearly in survival mode. They're going to have to adapt. They're diversifying both customers, their route to market and their range, and they're going to have to become more flexible to react, flexible to adapt and to reinvent. And they're going to right size. So we're going to see a lot of shift in this retail sector. Linked to that, I've mentioned tourism, and clearly hospitality in London is usually a thriving sector. London's a popular travel location for business and pleasure, but even now, today, many of our London hotels are remaining closed. There's been very low occupancies, only long-term residents really in situ. Only about 41% of London hotels are currently open. Across the UK, that's slightly more, about 54%, according to a Savills survey recently. Owners and operators have welcomed a government support. The VAT rate for hospitality and tourism has been cut from 20% to 5% through until January 2021. There's been lots of British people staycationing, as we would say, but it's yet to be seen really as to the effect of that and if that's going to have a significant boost to this really hard hit sector. JLL have quoted the potential really of up to 12 months before we see any genuine sustained recovery in demand. We'll see what happens there. You know, we all hope that will come back. A sector perhaps seeing more positive news is industrial and logistics. The fundamentals here were very strong prior to COVID-19. Occupier demand was very robust. Vacancy rates were near record lows. And this pandemic really has highlighted that importance of supply and demand, supply chain logistics, you know, getting things to the right places at the right time. So we've seen additional demand for manufacturing sites and logistics sites as companies are looking to focus on their domestic supply chain. So according to CBRE, the UK recorded a take-up of 19.1 million square feet during the first half of the year, which is higher than any quarter previously recorded. So I think that's some statistic. The majority of, or a big chunk of that, I should say, 40% of that was from the online retail sector. Finally, commercial and office, a bit closer to my heart. So at the beginning of May, Cushman looked back and published their review of the first quarter of 2020, which was already starting to see some challenges in slowing, and lease deals were, you know, becoming more difficult to progress, perhaps not just really based on COVID. Clearly, COVID had a swift impact, and of course, you know, inquiries have become increasingly rare, particularly for larger office space. According to CBRE, Q2 take-up totaled only 1.1 million square feet, the lowest quarterly take-up total since records began in 1984. So, you know, we're getting records at both ends of the scale, unfortunately, here. Slowdown particularly noticeable in the smaller end of the market. So there were only 53 deals under 5,000 square feet in quarter two. 80% down on the 10-year average. So that's a serious chunk down. And, you know, as somebody operating in the flex market sector, I would hope that most of those are ending up in that area. Availability in central London has increased somewhere between 16.1 million square feet, according to JLL, to 17.1 million square feet, according to CBRE. An increase by that level is seriously significant, predominated by second-hand space. And we're really expecting to see further increases in that second-hand space coming onto the market. Just this week, there's been an article published with data from the Society of Industrial and Office Realtors and McCalmont Woods Real Estate, where they're expecting London office rates to plummet by up to 40%. So a real significant rental rate drop, pretty scary. So we'll see. I mean, at the moment, you know, we would expect London to weather the storm, which is particularly topical because it's absolutely pouring with rain where I live today. So we'd certainly expect London to weather the storm more than the rest of the UK, but, you know, we shall have to see what happens really. And I think, you know, there's little that we know at the moment. You know, we have seen a massive shift towards home working. There's been much speculation about the death of the office, but I think, you know, probably all of us on this call acknowledge that the physical office is an important place to come to facilitate interaction, collaboration. Just what that looks like, the size of it, how often we want to go there is going to perhaps, you know, remain to be seen. We've certainly seen in our discussions at the Instant Group with our CRE consortium that several clients have raised the probability of reducing their footprint requirements in head office locations and increasing their home working and giving their teams more flexibility of choice of workplace, perhaps moving more towards a regional hub and spoke model. Something that we expect to see as well is a shift in the metrics that people are using to ascertain their, efficiencies of space. More health and well-being focus perhaps in the future. What we do know is things are not going to return to normal yet. The vaccine seems a little way off. The trajectory of the office market is being shaped by this pandemic, our government's response to that crisis and the impact of it. We're expecting clients to future-proof their portfolios, adapt, change their footprint, provide more collaborative space. But, I'm really interested to hear from the regional differences and, whether this is perhaps a global view or whether things in India, Pinny, are different.
Yeah. Sure.
I need to unmute myself. I apologize, Helena. So just as a recap for London before we pass the microphone to Penny, we discussed a number of concepts such as when we were planning for this event, such as the investors' appetite to reinvest and economic, what we call influencers, right? So such as the COVID coupled with Brexit. And we contemplated how much pressure can the regions take. And we all know predictions are fluid, as I mentioned earlier, but just as a recap, so overall leasing activity in Q1 of this year slowed significantly, right? So the slowest start to the year since 2011, yet the downturn cannot be contributed just to COVID-19, given that the impact was felt in March, which I think is fascinating, right? So the crisis is, like you said, significantly going to change the use of commercial real estate, and that health and well-being are becoming a greater driver of value, across all forms of real estate, which is again another interesting sort of, I wouldn't even call it trend. It's a systemic shift, which is the better for so many, right? So. And then in the near term, Instant has worked with several clients about the probability of reducing their footprint requirements in head office locations, right? Increasing their home working flexibility and giving teams just a sort of broader opportunity. Yet in the longer term, the thought is that the pandemic may accelerate moves towards greater reliance on regional hubs, right? So so that's all fascinating. Penny, good morning. Thank you for your time and for your insight about India and your willingness. This is my favorite, planning for these events is just as exciting as the event based on the conversations. You were so willing to converse when we were planning, so thank you. As I mentioned, and as Pallavi agreed, we need to schedule another tea or coffee to catch up.
Yes, we do.
In addition to Helena and Simon, you brought such valuable observations to our conversation, such as there's a downturn and there will be an upturn, that there is resilience in the marketplace, and some forms of business like the production of agriculture in India is very much on the rise based on the working population returning to rural parts of the country, right? And I mean, that's not something I was aware of or that I'm going to read about popularly. And I mentioned this to our attendees, as you have a great deal of intel about the economy in India and how it will influence real estate.
Yeah, thank you, Michelle, and thanks, Helena, for that insight into the London market. I'll pick it up from here, from the India region, and talk through a couple of insights and how the asset classes are looking. So as India's slowly opening up their restrictions and few spaces opening up, like the restaurants, a little bit of travel, and some of the office complexes, things are changing. So what does the economist think about all this? And that's always the key when we are looking at how the market is doing or what is it driving the market. So Oxford economists have revised and downgraded India's GDP growth forecast for 2020 to 3% from the 5.3% in 2019, which is a significant drop and a thing to be concerned about and worry. But on the flip side of that, they have projected super sharp growth in 2021 and GDP growth rate pegged at 11.3%, which if you look at doesn't really tie up. So where's the story, as I would question it? What's happening? You put it at 3 as the GDP now, and then you suddenly in 1 year expect it to go to 11.3. Well, the government's doing a good job picking up a lot of stress from the market. Central government bank has, increased the lending rate, decreased it, sorry, from 4 to 5.15. This enhances the liquidity in the market, gives some boost in the market sector. The move reduces cost of credit and home loans become a little cheaper. So how will it look? But the food inflation again keeps rising. And Michelle, as you said, everything is not COVID. Everything cannot be just pegged onto COVID. Yes, COVID is one of the key components, but there are other categories of business and growth and seasonality which will go along with all this. And I think governments are quite cognizant of these facts, and they are looking at all this with a sharp, close eye, and finance, I think, is really focusing on these numbers. So let's see. Again, Oxford rates the risk evaluation for India and they put it at a moderate level, that is 5 out of 10. And India ranks at 72 position from 164 economies. And this is actually better than the Asia Pacific average. So I think this ties up with the GDP growth. So there is optimism in the market. It will look up, and let's see how that happens. Where do most of the investments take place? I'll share some insight into the segment share. So office takes about 50%, residential takes 25%, retail 11%, industrial 10%, and park the others variants into 4%. So the near-term outlook for the economy is constrained by the potential supply-side disruptions due to the COVID. And that ties in, Michelle, to your point that in the 7 major cities in India, the labor actually moved back into the rural, back home. And that's what's driving some of these trends. The current slowdown has reduced private equity inflows, and institutional investors are on a pause. They are thinking where and what is the right time to invest, and let's wait and watch for that. As Colliers International predicts during Q1 2020, the PE inflows for Indian real estate declined by 62% quarter on quarter, which is a huge amount. And they're predicting 89% year end. That is close to 222 million USD and 16.4 billion by the Indian rupee. So what is going to happen during COVID or post lockdown? How are we perceiving real estate? How do we look at it? What are the think tanks working on in the back end? So office will always remain there. And to Helena's point that, it's not going away anywhere. Commercial asset yields, actually, people are taking advantage of this time. Some of the investors are really going all the way and more investing. And those probably are the large fish in the ocean, who can eat up the small fish. And that's fine. Well, it's an opportunity. Focus on defensive assets like warehousing, logistics, and data center are on top of the market in India. Distressed opportunities, but strategic buys and long investment plays, even in residential. We are seeing a lot of residential market coming up with opportunities that are going to be floated. So new funds to look at India for fresh allocations towards office and warehousing. Let's take the segment of office real estate. Again, as per Colliers International, gross leasing declined 36% year on year. That is ties up to about 16.7 million square feet across the 7 major cities. So India does not grow everywhere. It has pockets of growth in states and and some of the cities are leaders. So Bangalore leads in the leasing activity, and they had a share of about 32%. And then Delhi and NCR is about 16%. During H1 in 2020, demand from information technology and business process management did not slow down. They still went ahead, and they have occupied about 52% of the total leasing, which is good news, which looks promising. And I think that trend will continue. We forecast about 38 million square feet of leasing this year after the peak of 59 million in 2019. So the drop is not that significant that every sector needs to worry. And the hope is, of course, on IT and BPM sectors to continue. Where is the demand down in the cities? It's about 30 to 35%, expected to be year on year for a couple of years. And I'll just quickly give you a glimpse of some of the cities. Ahmedabad goes down by about 1%, Bangalore about 26%, Hyderabad 21%, Delhi 17%, Mumbai, a financial capital, about 15%, Chennai 9%, Pune 9%, and Kolkata 2%. And with this, the supply will go slow too. The markets read, and that's how the supply will slow down. And supply stats also tie up with the percentage, just a percent here and there difference. So what is really happening? Industrial and warehousing is peaking. And the Indian industrial and warehousing sector is on a growth tide. On the back of increasing demand from manufacturing, third-party logistics, the 3PL as we call it, and the e-commerce companies. So the Indian industrial and warehousing sector is benefiting from government policies, initiatives such as the Goods and Service Tax and Made in India program, as well as global trade dynamics and evolving consumption patterns, which we are seeing across the globe now. Growth in India's e-commerce sector is the fastest in the world, with revenues from sector expected to reach about 9 trillion in the next coming few years. The uptick in e-commerce-led warehouse demand is visible from significant investments in warehousing space made by leading e-commerce majors like Amazon and Flipkart, as per media report. Residential, I'm going to just touch it for a second, is according to market sources, residential sales plunged to a new low in top 7 cities during H1 2020. Due to nationwide lockdown, residential activity in all major cities witnessed around 70% drop. And there are only very few new projects launched during Q2 2020. What is the alternate asset class doing? Hospitality is the biggest downside, and they've really been hit by the market. Unfortunately, government has not stood up for them. The hardest hit is the occupancy, zero occupancy in hotels because international flights are all closed, no travel, even internal Indian movement is restricted. So they are the worst hit, and I think the recovery will be long and hard for this sector. And business loss from tourism is huge for India because India is a hub for tourism. What looks up is co-living and student housing. Now, this is a new sector that's coming up. Because of the new standards of hygiene and safety and social distancing, this could be a market to watch out for and will drive factors of managing occupancies. Opportunity for commercial terms will be stressed. Commercial landlords and residential developers will have to drop their prices to get in the people. This sector is actually used a lot by the students who move from city to city and settle into the larger metro cities where institutions for higher education are prime and key located. So this is a market that we can look out for, and it looks quite promising. Co-living is another one which will be more affordable for student groups. The highlight for India at the moment is data centers. The Indian government is going fully digitization program across all states, even entering into rural India. So India data center market is nearly double and should be to reaching 5 billion in 5 years. Data consumption, hyperscale, and enterprise demand to drive cloud-based and co-location data centers is going to be the lookout for. Also, some of the ports where the gateway cities like undersea cable network, quality power supply, and government land support is all supporting this sector. India's privacy laws, along with rising online content consumption, e-commerce transactions, e-payment gateways to spur increased need of data center rack space. So this is the place to look out for. Of course, large investments are already done, made in the cloud-based service providers. Colliers calls out what is the post-era going to look like for the real estate. This report investigates how the recession created by the pandemic is anticipated to impact the office sector in 3 key ways. A sharp but shorter-lived period of negative pressure on market fundamentals than the global financial crisis of 2008. This looks pretty promising. A more lasting effect on location strategy coupled with reassessment of floor layout and workplace. Uncertainty about the impact of remote work on space requirements. So I will leave you with 8 key takeaways. And these are things which are brewing in the background. Work from anywhere concept. Office workers will have greater choice in where to work. Flexibility is more crucial than ever. Occupiers are demanding greater flexibility in lease terms. Social distancing equals to de-densification. So some degree of de-densification will need to occur to meet requirements of social distancing. Sublease space is coming, but not right now. Companies will take time to fully assess their space needs, and they are at a pause mode at the moment. Tenants will look to the suburbs. Suburb office campuses with proximity to labor pools stand to benefit, and there will be an increased demand. Fortunes will vary from markets to markets, depending on tourism, oil and gas industries, and let's see where that goes. And this may decrease or increase demand. Investors to take a bifurcated approach towards core, low-risk assets or opportunistic purchases of discounted, distressed properties. Now these, where there are high loans in the market, may give opportunity to buyers. Demand for shorter lease could impact underwriting. Occupiers are gravitating to shorter term lease commitments, thereby creating a shorter income stream with implications for hold periods and ultimate evaluations. So I think these are just pointers to think about and how we should be looking at as we go ahead. Everything is very fluid at the moment. No one can put a finger and say this is the right way to move forward. So I think we'll have to wait. As Helena said, the vaccine is not in sight, but as it comes, things will pan out. And I'm pure optimistic. I think we'll be talking some different data next year and sharing that out with you all. So thanks for patience listening to me, and thanks, Michelle. Back to you to get to Simon.
Thank you, Penny. Thank you. I think one of the things that I want to point out for the attendees is that the 3 of you have collated information from major sources and condensed it and put it into this amazing package, right? So Penny, thinking about the fact that India's central bank in 2020 slashed the lending rate to improve liquidity, and the fact that Oxford Economics projects India to recover so sharply in 2021 with over 11% growth in the GDP. You know, it's interesting what we all pay attention to, right, as intel sources. And Simon, before we move on to you, Oxford Economics risk evaluation of India's economy says that their score is moderate, right? And that it ranks 72nd above 164 economies higher than Singapore. And I think something also that you shed light on, which is extremely valuable, is the focus on the data center market. Right. Yeah. The fact that the expectation is it's going to nearly double to what, 5 billion USD in the next 5 years. That's sensational. What does that tell us about technology and where it's taking us? Many, many, many places. That's where technology will take us, right? Your key takeaways, if I were to sort of simmer them and put them into the commercial real estate bucket, we say that, so that it is acknowledged that office workers will have greater choice, and flexibility is more crucial than ever for occupiers, right? So how deals are constructed is going to dramatically change. Helena, you commented on that earlier. The demand for shorter leases will impact underwriting. So what happens in the insurance market? So there's sort of a domino effect there, and that the sublease space is not coming right away, but it's something that people, are expecting to see. And then similar to Helena, that tenants will look to the suburbs. Where is the labor pool, right? Yeah, exactly. Thank you, Penny. Simon, I'm moving my head over to this side of the screen. Thank you for your time today. I introduced Singapore to the program as Pallavi and I were brainstorming about the concept of Accrue India and Accrue UK event. And honestly, I wanted to learn more about your market and help to inform others as well. So you were super helpful during the early planning to explain how the physical layout of Singapore influences real estate and what it means to the economy now that, for instance, the airport expansion project has been paused. So, and yet Singapore remains in high in terms of its investment outlook. Is that correct? Yes.
Yes, very much so. So thank you very much, Michelle, first of all, for having me in the panel. And obviously allowing me to cover a bit of the impact of the recent event on the Singapore real estate market, but also probably providing a bit of an overview of what Singapore is about in terms of real estate, but also macroeconomics and investment outlook to our audience today. So I'll probably cover in three key parts of the Singapore market. So starting with the investment outlook, then going through the macroeconomics and the impact that the pandemic is currently having on our economy here, and how that translates into real estate. And I guess covering the four key segments of real estate that we see being most active here, being the commercial real estate, the logistics industrial, the retail, and eventually the hospitality, which is obviously being very much affected at the moment through the pandemic. So I guess, to begin with the investors' outlook, and I guess quoting a survey that was undertaken by PwC and ULI last year in their emerging trends in real estate for the APAC market in 2020. Singapore is actually top of the chart in the city investment prospect. I mean, they had been number 3 in 2018, number 2 in 2019, and this year they're actually number 1 in terms of top city in APAC from an investment standpoint, and number 2 in terms of city development prospect. So I guess what it shows us from an investor standpoint is that basically it's a testament to the strong fundamentals of obviously the economy, and also I guess the investors' needs for defensive assets. And bear in mind that study was undertaken before the whole COVID situation. So I think furthermore now that's actually been reinforced. So from an investment standpoint, Singapore very much remain on top of the charts. I guess if we go through the key trends from an investment standpoint in terms of real estate, I would say the office sector is usually remaining one of the most popular assets. The vacancy rate in Singapore are anywhere around 10% in the commercial real estate, certainly slightly higher than a market like Hong Kong, which is only 4 to 5%. But again, with the trend and what's happening at the moment in Hong Kong, we might see a lot of, or potentially some foreign global companies as well looking at Singapore now furthermore as their regional and global HQ. So the vacancy rates are good. The supply is very well managed, and we'll talk about it in a minute, although at the moment there is not a whole lot of new supply coming on the market in the commercial over the next 2 years. It's been very well managed and planned. I mean, I guess globally Singapore is probably the world champion of city and urban planning, and that's how they've basically built the country over the past 55 years. So in terms of office supply and office yields, we've been looking at 3 to 4% office yields in the Singapore corporate real estate over the last couple of years. At the moment, we're seeing some slight rental adjustments, obviously, with what's happening with the pandemic and the fact that basically we're slightly shifting. It's obviously a landlord market, but I think at the moment tenants are having more opportunity in terms of being able to renegotiate some of their lease and certainly achieving some rent reduction moving ahead. So we're seeing some slight rent adjustment this year in the sphere of 3 to 5% decrease actually in 2020 on the commercial rental market. On the industrial and logistics, I think that I would very much echo the sentiment from what has been told in London and India. Singapore very much so. Logistics have always been seen from an investment standpoint as outperforming to a certain extent. And if we look at the trend now with e-commerce and what Pini was talking about in India, it's very similar in Singapore with obviously what's happening now and a lot of people doing their shopping online. The e-commerce is going to become more and more of a trend, and with the third-party logistics provider as well. And the way the country is being laid out, and I'll touch about it in logistics, we're undertaking a major relocation of the Singapore Harbour at the moment, which is, for those who know Singapore, used to be located in the fringe CBD area, literally next to the CBD, and is now being moved to the far west of the island, Tuas Port, who will be the largest globally fully automated port by 2040 when it gets fully operational. And bear in mind, Singapore Harbour is the number 2 biggest harbour globally, just after Shanghai. So those are the sort of infrastructure that basically support as well the real estate and obviously the economy from a logistics standpoint. Looking at retail, and obviously retail is being fairly affected at the moment with everything we're seeing from an investment standpoint. I would say it's probably an asset that has been potentially oversold, or at least investors are looking at carefully now. Vacancy rates are probably similar to the commercial market, around the 10%. And similarly, we're seeing rent adjustment at the moment in the retail, where certainly the retailers are having more and more to look at diversifying their strategy and looking at obviously a mix of online and physical shops for a lot of their brands. So we're seeing that. But I guess from an investment standpoint and landlord overall, I mean, sustainability is key in Singapore, and we like to call it a city in a garden. I mean, basically every new development in Singapore now is obviously integrating a lot of greeneries, and not only greeneries but energy efficiency. We've got our own system here, which is similar to your LEED system in the US. The Green Mark system here is basically implemented in the government for all the new projects, all the new built in Singapore. That allows landlords obviously to optimize their running costs, but also could be seen as a way to potentially maintain a healthy rent level because the buildings are so operational, efficient, and sustainable. So sustainability is key in the way obviously the city is being laid out, but also the new built environment is being considered. And I guess just to conclude on the investment, I mean, worth mentioning that last year, actually, the capital flow within the region, APAC region, we saw a surge of 23% year on year of the investment in APAC. If you put it in comparison with the US and Europe, where we were experiencing rather a decreasing trend, obviously that goes to show that obviously the region from an investment standpoint is still very much leading the charge from a real estate investment standpoint. So that's on the investment outlook. I guess on the macroeconomics, and just in a nutshell, because I'm not too sure the panel, I understand we've got people from all around the world. I mean, just Singapore, for people that are not familiar with the country, I mean, we're 5.8 million inhabitants here. That's pretty much half of what London, I think, overall population would be. We're basically gathered in a territory which is about 30 miles east to the west, 20 miles north to the south. So obviously it's an island, it's a city, it's a country, all at once. Worth mentioning that 22% of our land is actually reclaimed. So 22% of what Singapore is being built on is reclaimed land. So that again, that goes to show the overall city planning that has been thought throughout the development of the country. In terms of exports, and also worth touching on because that's kind of relevant to real estate and the situation we're in at the moment, 60% of Singapore exports are within the APAC region, with obviously China and Hong Kong taking almost half part of it. So obviously, when the pandemic started hitting, not only the market has decreased, but obviously the economy has been deeply affected because of obviously a slowdown in exports to those neighboring countries. So at the moment, the way we're looking in terms of GDP, we had a contraction of our GDP in Q2 of about 40% compared to Q1. So obviously massive. I mean, I'd say Singapore is probably one of the countries we've been of the first one affected, because obviously being very near to China and in the Asia region. And we're still going through obviously the pandemic, although the government has been handling it very well, and we're now at a very low rate of infection, but all the measures in place are still obviously being maintained. So that has an impact on the economy. So 40% decrease in GDP between Q2 and Q1, and 13% year on year, year to date. I think we're projecting a decrease of about 6 to 7% of our GDP this year. So yeah, obviously affected. But again, I want to touch on the long-term prospect and fundamentals, which I don't think will be too much affected, because again, it's been planned in the long term. So in terms of just touching on the COVID support measures, Singapore's dedicated 20% of their annual GDP to actually supporting the businesses and the economies to sort of go through obviously the crisis. So from a real estate standpoint, we've seen a lot of landlords, giving tax rebates and rent rebates to their tenants, which has been very, very welcome to many companies, and obviously a lot of job support scheme to maintain people in employment. So that's just on macroeconomics. I'll touching and bringing it back to our topic here of real estate. Office and commercial, as I said, this year the greatest supply is probably lower than the historical average, and that's going to remain the case until 2021. We'll see another hike potentially in 2022. That's all according to reports coming from CBRE and Colliers. This year in 2020, we've got 1.9 million square feet island-wise, which is just about two, with only two building, grade A new building with 79 Robinson Road and 30 Raffles Place. I think worth mentioning that efficiency is key here in terms of floor plate efficiency as well. So most of those buildings will be 20 to 30,000 square feet floor plates, allowing obviously tenants to optimize their fit out and the efficiency of their real estate. We expect the demand to be more balanced this year. It has been driven actually over the past 2 years, funny enough, by a lot of the flexible real estate operators, and working at Instant, that's something we follow very closely. Companies like WeWork and some local operators here have been very aggressive in obviously taking on new space, especially in Singapore, which has been driving the market up over the last couple of years. Obviously, it's not going to be the case this year and not in the near future either. The key sectors in terms of commercial real estate are still very much our financial institution, Singapore being a hub for global finance and insurance, and obviously tech industry, which is still very much leading the charge. I think something else also worth mentioning is on the size of the transaction. Again, I think looking at a CBRE report, last year, the bulk of the deals in terms of commercial leasing were actually smaller than 30,000 square feet. So we see a lot of smaller deals and clients in demand of more flexibility and agility in managing their portfolio. And that's one thing that Singapore and the landlords are having to adapt to. I mean, we see it a lot at Instant because we advise and consult and support our clients in that. But basically, that drive for flexibility and being able to more and more bulletproof basically their sort of commercial real estate portfolio. That's one thing we're seeing more and more from our clients, and something that the market here is adapting to. But overall, yeah. Sorry.
I just want to expand upon that a bit. So that relates back to something that Penny was saying as well, right? That there are certain economic influencers, there are certain drivers informing decision making. Yeah, so it's not just the price of the asset. There's other things going on. I also wanted to comment on the demand. What do you think the leasing demand falling back onto traditional sectors, right? So that small to mid-sized transaction of less than 30,000 square feet. That speak to something Helena mentioned and Penny mentioned too about regional hubs. And Singapore is so small. So Yeah, I'm just, if you just maybe a couple seconds of comments on that. What would be the driver for that in based on what you're experiencing in the marketplace?
I'd say in the case of Singapore, I mean, obviously companies are more and more looking at Singapore as being their regional hub. So obviously that it depends on the size of the company, but a lot of them will it'll be their port of entry to Asia, and obviously their regional sort of hub being located here. So I'd say it's the key sectors being those that we mentioned: the financial institution, the insurance, the tech. Especially now, furthermore, with the pandemic, and I think clients, and I'm sure we've got quite a few consultants as well in our panel. I mean, we can see a lot of our clients, I think, have difficulty potentially projecting themselves over the what's going to happen, during and after the pandemic. So again, that need for flexibility is more than ever something that we're having conversation about. I mean, the typical lease tenure in Singapore is usually 2 + 2, 2 year plus 2 years, or 3 years plus 3 years. So it's already quite short in a way compared to the sort of leases you can get in the US. But I think that's something we're seeing furthermore now. Certainly clients are looking at that. And not only that, they're also wanting sometimes either the operator or the real estate solution provider to take on basically the risk and basically run their kind of real estate and their fit out on their behalf, and basically provide them that turnkey solution with the flexibility that comes with it.
Wow, I have to tell you, I didn't understand the lease structure in Singapore, and now I do.
It's
As
that's one of the particularity, which
yeah.
also allows landlord to kind of renegotiate, and basically that's usually 2 + 2, the average. So again, that's on the commercial. Then you want me to explore further on the commercial, or because I was going to touch on the other sectors as well?
No, I think that we're at about we have about 8 minutes left within the hour that we've allocated.
Oh, okay, sorry.
This is
Do you want,
great.
Okay, in a nutshell, I can just touch on, because I think commercial was the most relevant, but just in a nutshell, I think on the logistics, as I said, it's I think I've touched on the logistics pretty much. So it's longer term, the infrastructure are in place to support the growth of that market, and is going to be driven more from the west end side of the island, which is where more of the logistics and the industrial hubs are located. Retail, as I said, is suffering at the moment, and I think is forcing probably retailer to relook at the way they go to market, but also landlord to potentially go back to relook at their expectation. Of course, as I said, Singapore is a landlord market, so it's driven by landlord, but still we can see more and more a gap in expectation between what the landlord expect for their property in terms of rental, and what the tenants are willing to pay. Hospitality, I just wanted to touch and to conclude on that, because Singapore is similar to India, also to a certain extent quite reliant on tourism, and hospitality being a key sector. Just to give you a few data, I mean, the Singapore Changi Airport used to be the 7th global airport in terms of number of passenger traveling through it. I think now we are ranked back to number 50, because obviously most of the border are still shut. There was an expansion plan for the Terminal 5, which was aimed to be completed in 2030 and was going to host 50 million passenger in its initial phase. That's been put on hold by the government, and they've taken that decision very early on during the pandemic when the pandemic started hitting us in the months of February, March, because basically they're relooking at the whole concept and wondering what's gonna come out of it. But basically, so that obviously it's shows a trend which is related the real estates, and at the moment we're not seeing a lot of new program, and there is very few little new supply in terms of hospitality for the next 2 years, 2021. The room occupancy rate being obviously very low compared to, I mean, similar to London, similar trend. I think we had a 60% occupancy rate last year. At the same time, now we're down to the 20-30%, and with most properties being repurposed for stay-home notice facilities and quarantine facilities. That's we're hoping that obviously things are going to get better, but that will depend on when can people travel again, and when our green lanes going to be reopened with some of the other countries. I mean, we're currently reopening one with Malaysia, but it's all going to take a bit of time. So obviously, hospitality as an asset and as a market in terms of real estate is at the moment struggling a bit, and it's probably going to be the case over the next couple of years from our observation. But again, if I can just wrap up on that, and not wanting to be too pessimistic at all, because I think actually of all nations, I think Singapore is probably, they've shown their resilience, and we've seen it in previous crises, whether the GFC in 2008 and the SARS that some of us experienced in Asia, that started in Hong Kong in 2012. So it's, sorry, before that, but basically Singapore has gone through it and has gone up stronger from those crises, and we're confident that that's going to be the same here. As I said, the infrastructure project and the long-term planning is here, and the fundamental from an investment standpoint are great. And obviously our clients are still looking at Singapore as still being one of their flagship and hub for their expansion across the region. So that's kind of the takeaway. I hope I haven't spoken too much.
Well, this is why we brought the panel together, and we focused on these three markets because there is so much information and intelligence to be shared and really broadcasted, if I may say that. So thank you, Helena, Penny, and Simon, for your time again and your intelligence. Chris, I just want to move on to the Q&A as we have a couple minutes left. So Chris, you've asked Penny a question. Thank you for popping that into the chat box. That's great. And Penny, I'm just going to read this in case others aren't seeing it. Penny, do you see a possible migration away caused by assumption of home working from the cities, as Helena alluded to, in the UK, right? So, and I see that in New York. I mean, New York right now is a very, very quiet place, and you can't find residential real estate within 10, 20, 25 miles of the city. I mean, upstate New York, Connecticut, New Jersey, where I am. So I think that's a very insightful question, Chris. Thank you. And then just to finish off the question, if so, is this a shift to the suburbs or to the countryside, the quality of life?
Thank you, Michelle, for reading that out. And thanks, Chris. And I actually responded to him on the privately conversation. Yes, there will be a shift. I think we will see that happening. And it does stem from the work from home. Earlier businesses thought they can never work from home, especially in a country like India. Office was office and home was home, and there were clear demarcations in both. Now it's all sort of married into. I think this will happen, and then keeping the metro cities where all the commercial hubs are and businesses set up. Bangalore as an example, which is choking at its ends because everyone wants to be in Bangalore because of the talent and hiring ease. People from other parts of the country go there. And that's another way of looking at it. But now that this work from home has opened up, people have been able to work from rural. And I think alluding to your point of technology and telecom and where we are heading, I think that's the future. Now it really will be very key critical services which will sort of have to come to work, and rest there will be a flexibility looking forward. It could be 2 days a week, could be from your rural home, could be from anywhere. So I think that is the future. Chris, I hope that answers the question.
Chris gave a thumbs up, yes. Well, we have just a minute or two left of our presentation today. And for the folks that have dialed in, I want to say thank you for your time. Thank you for pressing pause and listening and participating. We welcome questions. If anybody else has a thought, again, you have an expert from India, an expert in Singapore, and London on the line, and we're happy to chat for a bit more. Like I said, if anything pops up. I don't want to start calling out people, Penny, right? No. Recognize some names. Penny, I actually wanted to ask you, sort of the dynamic in the last minute or so that we have, the dynamic of, when things are shifting, things are changing, we're all talking about it and we're recognizing it. What happens to transportation when the regional hubs, right? When the regional hubs start to happen?
Correct. Yeah. So, I always look at it from two sides of the coin. I mean, the cities are choked in India. Travel times are huge. Transportation is pretty expensive. Pollution is so high. I mean, we all know New Delhi is the most polluted after Beijing or before Beijing. I don't know where the rating is now. And this COVID really has shown the blue skies. People never saw a blue sky and people never saw stars for such a long, long time. And I think all that is going to play into the minds of people who are working. And they are going to look at how they're going to be living either in the suburb. And yes, cities will have to gear up for that. Or they actually just travel once a month or, live in the state where they sort of belong and probably have a hub office. I think the future probably, and of course, I don't have a crystal ball that I can predict, but I think organizations, large organizations will have to split their portfolios into smaller hubs across countries like India, which are so large, and to tap into the talent, plus also create that infrastructure if they are not able to, like some of the states which are lagging behind in development and infrastructure, probably create some hub spaces for them. Similar to what co-working actually stepped into the real estate market and brought. I think, thinking on those lines probably will be the future, but don't know where we'll go. Let's see.
Let's see where this journey.
Thank you, Michelle.
Yes, thank you so much for everyone's time today. Again, this is going to be recorded. We'll share it with the attendees for reference. Shall we continue this in a little while, in a couple months? We'll circle back around. Yeah. Okay, sounds like a great plan. Well, thank you, everybody. Thank you for attending, and thank you to our panelists. And we shall see you soon.
Thank you.
Thank you all for
you.
attending.
Thank you all.
Thanks.
Thank you very much.
Bye.
Thanks, everyone.
Bye.
Goodbye.